And in our top business story, real estate investors across the region intend to be very active this year, according to CBRE's 2016 EMEA Investor Intentions Survey. Almost half of all surveyed expect their purchasing activity to be higher than last year, compared with just 15% who expect to be less active buyers. 43% also expect their selling activity to increase, indicating a buoyant and liquid real estate investment market for the region in 2016. Despite this commitment to real estate investment, one notable change has been a decline in investors' appetite for risk. The proportion of investors who see prime or core assets as the most attractive part of the market has jumped from 29% last year to 41% in 2016, which is partly explained by investors' concerns over economic issues. Diverging investor views were prevalent in the responses given for the most attractive country for real estate investment, with Germany as the most frequent choice as investors at 17%, the UK with 15.1%, and Spain at 10.2%. When it comes to investment in the Middle East, CBRE suggests that there is a substantial mismatch between supply and demand, stating that despite the significant development of commercial and residential property over recent decades, the number of commercial transactions involving foreign investors does not adequately reflect the interest in real estate in the GCC. The National Bank of Abu Dhabi has increased its 2015 dividend after investor pressure, according to reports quoting the bank's chairman, Nasser Ahmed Al-Suwaidi. The move highlights the dilemma UAE banks face in continuing to reward shareholders at a time when the impact of lower oil prices is squeezing business and could put pressure on capital. The UAE Central Bank has already flagged concerns about dividend payments and safeguarding bank liquidity, telling lenders they would need to get payouts approved. NBAD's new figure of 0.45 dirhams per share, announced at the bank's annual shareholder meeting, is up from the 0.40 dirhams the bank proposed paying when it unveiled its annual results in January. Increasing the dividend brings it closer to the 2014 yield, when NBAD distributed a 0.40 dirhams cash dividend as well as a 10% stock dividend. It also puts it in line with Abu Dhabi Commercial Bank, which is paying 0.45 dirhams for 2015, and ahead of Dubai-based Emirates NBD, which gave shareholders 0.40 dirhams a share. NBAD was hit hard in the second and third quarters of 2015 by deposit outflows, as the UAE government drew upon reserves with local banks to help shore up its finances. Most of the UAE's banks, including NBAD, have been seeking to cut costs, including staff redundancies, to manage the expected slowdown due to lower oil prices. And Dubai Investments, in a statement released today, has proposed paying a 12% cash dividend for 2015. The proposal put forward by the Board of Directors for approval by shareholders compares with a dividend for 2014 of 12% cash and 6% bonus shares. The conglomerate, in which the Sovereign Fund Investment Corporation of Dubai owns an 11.5% stake, last month reported a 2.6% rise in fourth quarter net profit. Passenger vehicle numbers in the Gulf region are estimated to increase at an average of 7.4% annually over the next 4 to 5 years. New research has revealed that a total of 19.1 million vehicles are expected to be on the region's roads by 2020, up from 14.35 million in 2015. Despite a slight decline this year, vehicle sales in the GCC will stabilize in 2017 before a cumulative growth phase from 2017 to 2020 puts the region back on track as the Middle East and North Africa's largest automotive market. According to analysts Frost & Sullivan, Saudi Arabia will hold the lion's share of cars on GCC roads with 10.03 million vehicles by 2020, which is 52.5% of the entire regional market. The UAE will have 3.53 million vehicles, an 18.5% share, while the rest of the region, which includes Kuwait, Oman, Qatar, and Bahrain, will have 5.54 million vehicles, Kuwait being the largest, followed by Oman and Qatar. According to the Frost & Sullivan, the average age of cars in the region will increase to 8 years in 2020. By then, 0 to 3 years old vehicles will contribute 27% of units in operation, while cars aged 10 years and older will dominate the market, holding a 31% share.